Welcome back to Be Rich. After Namakkal, my team decided to do an event in Vellore. We have familial connections with Vellore. My father went to college in Vellore. He attended the Wooders College. So we are doing an event in Vellore on the 20th and 21st of July. Those desirous of attending this event should contact the WhatsApp number given below and send a message to the Gmail ID that is also given. Try to call as early as possible to avoid rush and disappointment. Because in Namakkal, we had to decline a lot of people who wanted to attend the event. Once again, I thank you for supporting Be Rich. Good evening and welcome back to Be Rich. One of the biggest proponents of the efficient market theory is a man called Eugene Fama. He is a Nobel laureate, and Eugene Fama was a member of the Chicago School, which believed that all markets were efficient, market knows everything, and markets discounts all information. It was the height of the rational man theory. That is, everybody in the market knows everything. There is no value to be found in the market. And by buying the stock market, buying the index, you know the whole thing. Eugene Fama's most famous student was Jack Bogle, who started Vanguard in passive investing. But we are not talking about passive investing today. We are talking about another student of Eugene Fama called Cliff Ennis. He started what is known as the AQR fund, and he's an active fund manager. But normally they have both passive and active funds. Looks oxymoronic because Eugene Fama believed that market knew everything and there was no skill in being an investment manager. But he did well. His funds in 2022 beat the market by a huge margin. His funds returned 45% in 2022. And therefore, he had an interview in the Financial Times of London. He practices in a particular style of investment called factor investing. So, factor investing, there are various factors, and you allocate your money depending on how the company is doing in each factor.
And in that, price momentum is also one factor.
So there is fundamental momentum, there is price momentum. Even if the fundamentals of a company are not good, but the momentum is behind it, and the pricing is moving forward and more liquidity chases it, then that company will do well. It's similar to the quantum theory of in investing by George Soros. Markets are fallible, but if there is a reflexive reaction between the market's forces and a fallible belief, what happens? There's a self-reinforcing bias. So even though that the self-reinforcing bias is wrong, the market keeps pushing the price of these assets higher and higher. In some cases, there's a kernel of truth in the fallibility. That is what is happening right now in AI. While Apple's results may come in 27, 28, Nvidia's numbers are really good. The P by E ratio of Nvidia is not 100 to 100. It is in tolerable double digits because they are making GPUs which the world wants to buy. So there is particularly sales happening, profits being made. The question is how the profits are being discounted. So there is some element of kernel of truth. There's a lot of fallibility. The market is reflexive and therefore the prices are rising further and further. Somebody who does price momentum as factor investing would have gone long on Nvidia, knowing fully well that the fundamentals do not fulfill all the conditions and would like to go along with the market, like what George Soros said. And since these guys are fund managers, would try to get off at the right moment and maybe short the market all the way down. This is what I understood from doing factor investing in price momentums. So let us see what Sashwath has picked up from that interview and take his point of view.
Yeah. So 30 years ago, Cliff was a PhD student under Eugene Fama in the Chicago School. He was a Wharton business graduate before that. So the question was asked to Cliff, saying this was more about passive investing, and the author of Unhedged, Robert Armstrong from FT, interviewed him. And he asked him, saying that what happens when more people decide to go into passive? And Cliff says that no clue what happens when more people decide to go passive because it's too early to tell what the end result will be. So the question then becomes, as more of the market moves towards passive, do the factors your strategy depend on become less or more pronounced? And Cliff says, final answer is that no one knows, but it depends on the proportion of smart versus foolish investors who move to passive. Of course, he's being cheek and tongue here by calling investors smart and foolish. What he means to say is those who have experience and those who do not have experience. And he said that 2000 saw a wide valuation multiple spread between stocks, and 2020 saw an even wider valuation spread. And he says that in general, the market has, according to him, gotten less efficient over his career. He said that more smart investors have decided to go into passive because passive is actually not a bad idea. It's a pretty smart idea to do. And he refers to this person called David Einhorn. And he says that David Einhorn's comment, which is that the market is so inefficient, you cannot make money. This sounds paradoxical. If the market is inefficient, there's a lot of money to be made. But what David Einhorn is indicating is that when the market is so incorrect, there is no scope for correction even though you are correct. So suppose you make a right bet, the amount of pain which you have to go through until the market realizes that you were right and they were wrong will be a long time. That's what David Einhorn is indicating. David Einhorn is the founder and managing person of Greenlight Capital. And David Einhorn's comment that the market is so inefficient you cannot make money sounds paradoxical. But what he's meaning to say is that the market has gotten so inefficient and it's so wrong that the market doesn't even realize when it has gone wrong. And for most value investors, the market has to at some point realize that it has made a mistake and start treating your stock well. But for the market to do that, there has to be an ounce of efficiency, which David Einhorn is being hyperbolic here by saying that the market is so inefficient you cannot make money.
He is not being hyperbolic. What he means is that the S&P 500, most of the money, more than 60% of total money is going into the S&P 500. And it is not an equal weighted index.
Yes.
It's a free float index.
Yeah.
So what happens is more and more money is allocated to companies which are doing well. So what he is saying is 3 or 7 companies represent nearly 30%, 40% of the index. The balance 490 companies represent only 60% of the index.
Yeah.
It's not just plain buying the index. You buy those companies. So what is happening is, even if these Magnificent Seven are inefficient, more money is chasing the Magnificent Seven.
Yes.
So any drop happens, they say correction, it drops, people go in buying more. So there's no stopping the Magnificent Seven. If the Magnificent Seven corrects, you have a wall of money coming in to buy into it and pushing it back up. That was not true in the back days.
Yes. Back when Benjamin Graham was investing.
Not only Benjamin Graham, even 2000,
Yeah.
it was not, Vanguard funds was not as strong as it is today. So there is a wall of liquidity which is not allowing expensive stocks to correct.
Yes. Hey guys, I'm going to quickly interrupt this video to announce that we have successfully launched our Substack, where we talk about companies, US markets, European markets, and Japan as well. And these insights are going to be delivered straight to you to your email as well as the Substack app. We hope you go check it out. The link is moatinvesting.substack.com. The link will be on the screen right here and also in the description. Thank you for checking it out. And the person who determines the winners and losers are the rest of the people who are still actively managing. Because the active traders are trading amongst each other and pushing certain stocks up in the S&P 500.
Yes.
Which then passive is passively flowing into according to the weightage.
Yes. And so that keeps on, there's again that feedback loop comes.
Yes.
And it gets getting higher and higher.
And another problem, or not problem, another phenomenon is that there's a clear bullish bias, because idea of passive is that you don't touch it for a long time.
Exactly.
So you're going to keep putting money into it without anyone pulling it out in large droves.
So that is why he said, what I also have felt, even in 2008 I felt this, when a correction happens, that quickly fills in the gap.
Yes.
You don't get a long time to put your money in.
Yes. And so what Cliff says is that the time frame and pain you have to go through has increased. But if you can take the other side of an irrational bet, it's definitely lucrative still. He says that value has had a bad run in 2018 to 2020, but did way better after that. And he says that global value has been stronger than the US. And he says that they do not take in his fund, the AQR, does not take industry bets and do not use book to price. And he says that it depends on whether there's a richening or cheapening of your strategy, which is your longs are getting more expensive and your shorts are getting cheaper for your returns to be realized. This component of value investing has increased. He says that this is a marked shift from when Benjamin Graham used to invest. He says that yes, fundamentals is the theory of value is that fundamentals drive your returns, but now it has become more of a speculation on the price of the stock rather than any fundamental change in the company itself.
I think this is because amount of money the central bank has created, and then the money has not gone into the main street,
Yeah.
and the money is circulating in Wall Street among banks and financiers.
Yeah.
And that's what he is talking about. When a new gush of cash comes, it keeps the overvalued asset even more overvalued.
Yes.
That's exactly the point he's making.
And he says that problem is you have no other choice. No one knows the future. The US crushed everyone the last 15 years. But before that, the rhetoric was, why invest in the US when global markets are there? Why invest in the US when China is there? But in the last 15 years, the rhetoric has become US is the place to be. And US markets have undeniably crushed Indian and Chinese markets. So the US is far more expensive than the world today. It was cheaper in 1990, and almost all of the US victory, according to Cliff, has been from a richening of the valuations rather than anything fundamental which the US has done differently in the past. And he says that you have to do the right thing, which is to invest in value. But the problem is that the time scales have changed. Before, your value bet could be realized in shorter periods, but today the period between two recessions have increased, according to Cliff, and which also is supported by data roughly.
The central bank does not want you to take any pain.
Yes.
So it creates a wall of liquidity.
Yeah.
The wall of liquidity through passive funds is supporting stocks which even show minor corrections.
Yes.
So the bias is towards large cap and especially to those companies which are there in the index.
Yes. And he says that interest rates have been falling for 40 years in a massive rate, and it's become a massive threat to deal with, and multiple stocks have gone up in general due to this. And multiples, that is price to earning multiples, have also gone up due to this. They've trended upwards. And he says, and 10 years of highly suppressed rates have contributed to this irrationality which is seen in the market.
Something which everybody has been talking about.
Yes.
But even these increased rates are not affecting the market. So I think the rate should be longer, higher for longer, like he has indicated that he will keep it till December.
Yes.
If such high rates is not able to sink AI stocks, I don't know what will.
And he says that the illiquidity premium is much smaller or even negative these days. And he says this is the reason private equity has done so well, because even though they're illiquid, they've done much better than, let's say, a general fund manager, because illiquidity is being favored, at least has been favored for the last 20 years. And then he was asked the question by Robert Armstrong, a tough question, which is, how does Jim Simons beat the market routinely if Eugene Fama was correct in his hypothesis? To which Cliff replies that the amount of money Jim manages matters. He says that Jim has mostly thrown out all his external clients, and today Jim only manages money for the Medallion Fund's employees as well as himself and close family relatives. So he says that Jim takes out about $2 to $3 billion from the market a year, roughly. That's a drop in the water in terms of market efficiency. He says that the AQR fund manages over close to $200 billion worth of assets, and this is a huge amount of money which, if given to Jim, he would not be able to replicate the same performance which he has been able to do.
Something similar to what Buffett said.
Yeah.
If I had a few hundred million, I'll be doing it at 50% a year.
Yes.
And because I have hundreds of billions, I'm not able to do this.
Yes.
So he said, if you're a small investor, you can double your money at least every year, or
Yes.
at least once in 2 years.
So he says that Jim Simons performing isn't really something which goes against Eugene Fama's theory, and especially he gives out a story that when he was a teaching assistant for Eugene Fama, as usually PhD students are teaching assistant for undergraduate courses, and Eugene Fama in one of the lectures opened up by saying that the markets aren't efficient, and the entire Chicago cohort gasped. And Cliff says that only in Chicago can you get away with saying that the markets aren't efficient and get a gasp from everyone. If you went and said this on the street, everyone else would say, are you a lunatic? We all knew this well before. But in Chicago, that got a gasp. And what Cliff says is that even though Eugene Fama hypothesized about the efficient market hypothesis, what he ends up saying is that Eugene Fama believes the market is much more efficient or capable of returning to equilibrium levels compared to the average person. However, Eugene Fama does not believe that the market is efficient at all times. And the level of efficiency also is a question. And finally, he also talks about a strategy of fundamental momentum. He says that you have to cash in on companies whose fundamentals are moving in the right direction, which is what he does. And
Exactly what something like with Soros says.
yes.
So this is a combination of Soros and Buffett. When you ought to be a Soros or when you have to be a Buffett, but it's way beyond our pay grade. So play defensive, buy a cheap stock, and wait for the time to come. Thank you for watching. Be rich. If you like this video, hit the like button, subscribe to our channel, turn on the bell notification. If you have already done all this, please send this video to your friends and relatives and ask them to take a look. Once again, I thank you on behalf of Be Rich.
Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.